Swayam Prabha. Digital India. Educated India.
Hello everyone, welcome to the new topic, permanent financing for developments. This is part of the course Real Estate Finance and Investment Strategies. So first we will be talking about the learning objectives of permanent financing. This will be continuation from the last class where we have seen construction financing, where we very briefly also saw that what is the difference between construction and permanent financing. In this particular lecture, we will be focusing on permanent financing and try to achieve following learning objectives. So, the role of permanent financing in the development life cycle, key types of permanent financing available in India, decision framework for selecting appropriate financing strategies, implementation processes and underwriting considerations, and current market trends and challenges in permanent financing. So, the first, the development financing life cycle. So, there are three distinct phases here. We have pre-development financing, then second construction financing, and the third one is your permanent financing. So, we have seen the construction financing and we have also seen the difference between construction and permanent financing and how they differ from each other. So, let us look at these phases. So, phase 1 is pre-development financing. This covers your land acquisition, due diligence, design work, and obtaining all necessary approvals and permits. Typically, this phase lasts 6 to 18 months duration and you are essentially paying for the right to build and getting everything lined up. Then phase 2 is construction financing. This is where the actual building happens and construction or rehabilitation work takes place. So, the key characteristic here is the progressive disbursement structure. So, we have seen that here the loan will be in stage wise, right, because the progress has to be visible for the loan to be procured. So, that is what is unique about this particular stage. So, you do not get all the money upfront in this, but in phases you are getting it, right. So, this phase typically runs 1 to 3 years, right. Then phase 3 is what we are focusing on today, permanent financing. This is your long-term operational phase financing, and we have also seen that construction financing and permanent financing, as permanent financing has lesser risk, so the rates are also reflective of that and they are also less in this particular phase in comparison to construction phase. Also, it is longer in nature in comparison to construction financing. So, typically you will see that it is for 5 to 30 years duration and it's replaced the construction loan. So, sometimes we have P2C, C2P loans where from construction to permanent financing the loan transforms and there is a dip in the rate also which takes place. So, some companies also go for that and some lenders also have these kind of products. Then what is permanent financing? So, the definition is long-term loans used to pay off construction loans or other interim financing after a real estate development project is completed and stabilized. So, after the project is completed, it has been stabilized, now it is in normal operational mode. Then in that particular stage, this particular financing comes into picture. So, longer term, like for example, 5 to 30 versus 1 to 3 year for construction is one of its characteristics. Then generally lower interest rates in comparison to construction loans, which we had seen in last class. And then amortizing payment structure generally followed for this is because now there is much more stability and amortizing payment structure can be followed. In construction loans, we have seen that during the loan disbursement stage, which is in stages, there is a deduction in the loan itself, because otherwise how will the installments will be paid. So that is what the process is followed, and then there is a balloon payment at the end. Here you are seeing that there is a amortized payment structure of regular payments. That kind of structure is followed here. And then based on the properties operational income, that how much regular income it is there with that particular project, and that it is based on that. And then it requires property stabilization, that the normal operations have begun. If it's a office building, the tenants have come in. If it's a retail business, so the mall has started and the different tenants have taken the shops and everything. So that kind of certainty is required before you get this permanent financing. Then what is the purpose and benefits of permanent financing? So refinance construction debt at lower rates, which will of course be followed by construction phase, it will be followed by permanent phase, and the debt here will be lower in comparison to that, because the risk has gone down now, it's in operation state now. Then stabilize cash flow with predictable payments. So there is a stability in cash flow, and predictable payments are being there. So that is why this thing can be thought of. So instead of uncertainty of short-term loan renewals, so that is why this is better. And third, you can extract equity for new developments. This is how successful developers scale their operation. Fourth, you eliminate refinancing risk from short-term loan. No more sleepless night wondering if your construction lenders will extend. And finally, it enables the profit realization from the development. You can actually harvest the value you have created. So the benefit to developer are substantial. You get improved cash flow predictability. You know exactly what your debt service will be for years. You achieve reduced interest expenses through lower rates, and you create capital recycling opportunities, pulling equity out to fund the next project that you can do now. So you achieve enhanced project returns through optimized capital structure, and perhaps most importantly, you get risk mitigation by moving from short-term to long-term financing. Then we have Indian permanent financing landscape. So Indian permanent financing market has some unique characteristics you need to understand. It's an evolving market with growing sophistication. So that is what was available 5 years ago pales in comparison to today's option. We are seeing increasing international participation. So more and more standardization, more and more international companies, more and more international investment companies are coming in. They are participating in Indian real estate. So of course, there is a standardization of the market also happening along with it. Then REIT market providing new exit options. So we have seen in the last class that there we took one particular case study where the option with Mindspace was that they can, Mindspace REIT was acquiring, and that is why there was a easy exit available, and that impacted the loans also, the loan terms also, because it was a pre-decided contract between the contractor and the REIT that they will be transferring, they will be accepting that property. So that kind of arrangement was there. So the lender also was able to lend. So this is something new which is happening. And then focus on grade A properties in tier 1 cities is also something which is being now looked into. That many such tier 1 grade A properties are being going for this. So that is the thing. Then there is key players in this space include scheduled commercial banks like SBI, SDFC and ICICI. These are your traditional lenders. You also have housing finance company that specialize in residential projects. We have NBFCs like Piramal, Edelweiss, Kotak are increasingly important, especially for more complex deal. And then we have international institutional investors who are bringing global capital and expertise. And finally, we have REITs and InvITs creating new exit strategies that can influence your permanent financing solutions. Then we have regulatory framework. So we have Reserve Bank of India, which is bringing banking regulations. We have SEBI, which is regulating REIT and InvITs. And then we have National Housing Bank, which is regulating the housing finance. And we also have external commercial borrowing guidelines. We have FDI policies and real estate exposure norms for banks and RERA compliance requirements, which are also there since 2017. So these are the regulations also which needs to be looked by experts in this field, developers in this field. Basically, the stakeholders of this field should be well aware of the regulatory framework and the responsible authorities which are forming these rules. Then takeout financing. So let's dive into this. That is the first major type of permanent financing. The name tells you exactly what it is. It takes out or replaces the construction loan once development is completed and stabilized. So the structure follows a specific sequence. You start with a commitment stage during construction. The permanent lender commits to provide the take out loan once certain conditions are met. During the construction period, you operate under a separate construction loan. Once you achieve stabilization, typically 7 to 80% occupancy with quality tenants, you execute the takeout. Then you move into long-term services for 5 to 30 years. So this structure provides certainty during the development process because you know your permanent financing is already lined up, assuming you meet the performance criteria. Then we have types of takeout financing in India. So we have traditional bank takeout loans, typically 10 to 15 years terms with 60 to 65% LTV ratios. The rates and underwriting are conservative, and your primary providers are major banks. These are straightforward traditional permanent loans. We have then lease rental discounting, which is more sophisticated. The structure is essentially loan against future lease rental. The lender is underwriting the quality of your lease income. You can get 10 to 15 years terms with 65 to 75% LTV ratios for grade A properties. The focus is heavily on strong tenant covenants, right? Who your tenants are matters as much as how much rent they are paying. So basically, that is also important. Then LRD can offer better terms because the lender has more certainty about the income stream, but it requires high quality properties and tenants. Then we have takeout financing requirements. To qualify for takeout financing, you need to meet specific completion requirements, financing thresholds and documentation standards. We have completion requirements, include obtaining your occupancy certificates. This proves your building is legally ready for occupation. You need minimum occupancy level of 70 to 80%. You have empty buildings, don't qualify, and there is a strong preference for grade A tenant profile to reduce the lender's risk. Then financial threshold are equally important. Minimum DSCR of 1.25 to 1.50. Your net operating income needs to cover debt service with a comfortable cushion. Maximum LTV is typically 60 to 70%. So basically, these are the requirement financial thresholds. And then documentation, clear property title. Of course, that is very important that property title is clear. Executed lease agreements. Lease agreement should be executed, preferably longer. We should have proper environmental clearances because there can be sometimes bigger commercial projects or residential projects. They might be, especially in case of Mumbai and other coastal areas, we have often heard of cases of coastal zone regulations. And then fire NOC and other approvals should also be clear, and that is some important documentation which has to be there. Then we come to one example here. So this is a real world example to make this concept clear. A typical grade A office building in Bengaluru has a property size of 500,000 square feet, development cost of 400 crores and 85% occupancy to MNC tenants. Average rent is of 85 per square feet per month and generating a current NOI of 40 crore annually. The takeout term achieved were quite attractive. 300 crore loan amount representing 65% LTV. Term was 12 years with a rate of 9.25% fixed for 5 years and then reset. DSR was 1.18x. This is on the lower end but acceptable for high quality property with strong tenants. So this example shows how property quality and tenant strength can help you achieve favorable financing terms even with higher leverage. So even though the DSCR ratio was on the lower side, but because of the overall quality of the tenant and the overall the developer, the office building, the way it was there, it was considered for the loan. Now we have mini perm loans concept. So key feature include term of 3 to 7 years. Basically, this serves as an intermediate financing solution, bridging a construction loan and long-term permanent financing. And like I said, the key feature here is the term of 3 to 7 years, which is longer than construction but shorter than permanent, as it is somewhere between construction and longer it is construction and permanent financing. So this is expected. Then the purpose is to provide financing during the property stabilization period. So during the stabilization period, this is the loan which is providing. It is still not stabilized and it is not under construction stage. So during that period, we are talking about the mini perm loans. Then structure often includes interest only payment initially, giving you cash flow relief during lease up. However, the exit requires refinancing at maturity and you will need to secure permanent financing before the mini perm expires. So there are two types: hard mini perm with fixed maturity and no extension. You must refinance or face potential foreclosure. And soft mini perm includes built-in extension option, more flexibility but typically at higher rates. So mini perm applications in India: properties in emerging submarkets, mixed use development with phased completion. So let's understand this. Properties in emerging submarkets where long-term lenders are hesitant but the fundamentals are strong. Mixed use developments with phase completion. Different components may stabilize at different times, and that kind of arrangement. Then we have retail properties needing traffic establishment. Malls and shopping centers often take time to build foot traffic. That will be an example. And then project requiring post completion enhancements, additional work needed after occupancy certificate, and an international investor entering the Indian markets who wants to test the water before committing to long-term financing. So they all are going for this kind of loan. So major providers include NBFC like Piramal Capital and Edelweiss, specialized real estate funds, international investment funds, and joint lending arrangements between multiple lenders. So mini perms are particularly useful when you are confident about your property's long-term prospect but need time for the market to recognize that value. So you will be convincing, you are convinced that you have long-term potential, but the lender has to be convinced, and meanwhile this kind of loan is something which you can avail. Then mini perm versus other financing options. Let's take a look of that. So mini perm offers 3 to 7 years versus 1 to 3 years for construction loans, and 10 to 30 years is for permanent loans. So this is somewhere in between. Then rate, mini perm typically we have 9 to 12%. Again, something you can see in between the construction and permanent loan, just like the stage at which the project is currently. LTV similarly exactly middle placed, 65 to 70% in comparison to 70 to 80% for construction and 60 to 70% for permanent loan. And then occupancy required is 60 to 70%, which is just about to start condition, because you are stabilizing. So it is expected that occupancy will remain low initially. You are looking for tenants and tenants are coming. And of course construction loan, there is work still going on, so there is no tenant, and in permanent loan there has to be 80 to 90% occupancy at least. And then refinance risk are there in money perm and construction loan, and flexibility, refinancing risk is there, then flexibility is high in mini perm, which is we have seen that there are options available. So that kind of difference we can clearly see between these three different financing options. Then we have construction debt assumptions. So construction debt assumption is often overlooked but can be a powerful strategy. Instead of refinancing with a new lender, you modify existing construction loan terms. Key elements include maturity extension from the typical 1 to 3 years to 5 to 10 years. You negotiate interest rate repricing, hopefully to lower rates. You introduce an amortization schedule instead of interest only payments. Covenants modification may be necessary to reflect the property's operational phase, and you might achieve potential guaranteed reduction as the project risk decreases. Now, types include full assumption of entire construction debt, partial assumption with some refinancing, and phase transition as milestones are achieved. So this strategy leverage your existing relationship and can be faster and cheaper than starting fresh with a new lender. Then, when to consider construction debt assumption? So, favorable scenario, strong developer lender relationship will be very crucial here. So, this strategy relies heavily on relationship banking challenging credit market conditions, making it attractive when new financing is expensive or unavailable. Limited competitive financing option in your market or property type, need for quick execution when time is critical, and projects with PSU bank financing where the relationship and terms may be particularly favorable. Market condition that favors this approach include credit market disruptions where new lending is constrained, rising interest rate environments where your existing rate may be attractive, limited permanent financing availability in the market, and relationship banking preferences where financing availability in the market and relationship banking preference where your lender values the ongoing relationship. Then we go to construction debt assumption process. So the process follows three distinct phases with specific timing. Initial assessment, which is 3-4 months before maturity. You evaluate market conditions to see if assumptions make sense versus refinancing. Analyze existing loan terms to understand what you are working with. Assess project performance to strengthen your negotiation position, and begin preliminary discussion with your lender. Then phase 2 is negotiations. Takes place 2 to 3 months before maturity. You present a formal modification proposal with specific terms, negotiate extended maturity and revise rates. This is where relationship matters, and discuss modified covenants and reporting requirements, and conduct updated property appraisal to establish current value. Then we have phase 3, documentation and execution. Happens 1 to 2 months before maturity. You prepare loan modification documents obtain internal approvals from both sides and execute modification agreements and implement the revised payment structures. Then we have advantages and disadvantages. So one advantage which we can see is the reduced transaction cost, 0.5 to 1.5% savings. Then time efficiency and streamlined process. There is leverage existing lender relationship. So that is there. Your lender knows you and the project. So there is a relationship between you. And then greater flexibility in structuring terms that work for both the parties. And then protection for market timing risk. You are not subject to current market conditions. Then disadvantages are also there. So limited to single lender, no market competition. You lose negotiation leverage, right? And then potentially higher cost than market alternatives. You might get better terms elsewhere. That can be the case. And then lender constraints on loan duration. And they may not want very long terms, and increased relationship concentration risk. You are putting more eggs in one basket. That is the situation here. And possible stricter terms than permanent loans, since it's still essentially construction debt. Right? Now coming to the decision framework, we have project characteristics should drive the financial choice. So for example, commercial office, the suitable will be takeout financing, LRD or re-takeout. We have seen the examples earlier that the Hyderabad example of Mindspace taking over the property, there was a pre-arrangement. So that is a condition. That kind of arrangement can also be there. So that can be another useful thing. So that way you can see commercial offices now also in India. Then we have retail, where mini perm, structured takeout, that can be the ones which we can go for. Key factors are your foot traffic and tenant mix. Retail actually takes time to stabilize, more than at least the office. And then we have residential. We have housing finance loan or construction assumption. So key factors are RERA compliance and sales velocity, how quickly you can sell units. And then we have hospitality, where usually requires mini perm or specialized lenders. And key factor is performance establishment. Hotel needs operating history basically. And then we have industrial properties that work with bank permanent or NBFC products. And the key factors are location and the connectivity, because access to the transportation network should be available to that property. Then we have decision framework, scale and location. So small projects, 10 to 50 crores, we can see that typically they rely on domestic banks with relationship based lending. Your options are basically limited, but the process is often simpler. Then we have medium projects of 50 to 200 crores. We have NBFCs, some international interest is also coming up. You have more options and can often negotiate better terms. Larger projects, 200 plus crores, open up international options, because then they are interested. REIT potential is also there if it is commercial office space. Generally, till now we have like 3 REITs which are in office space, and there is one REIT which is in the retail area. So that option is also now, like, we discussed is opening up. And then we have location considerations. So we have, like for example, tier 1, most financing options are open and its competitive terms are also available. Tier 2 cities, limited lender universe, higher spreads will be there. And tier 3 basically based on completely relationship based and very conservative underwriting will be there. Then key financial metric comparison. So take out financing, basically offer 10 to 15 years term with 60 to 70% LTV at 8.5 to 10.5% rates. The DSR requirements are 1.25 to 1.35 times. This is basically the main permanent financing. Then you have mini perm, gives you around 3 to 7 years term, LTV of 65 to 75%, rates will be 9 to 11.5%, and DSCR can be a little less, 1.10 to 1.20, because like we have discussed that it is still not stabilized, and after construction it is still trying to stabilize itself. So business is in that infancy stages, so it's still growing. And then we have construction assumption, where the terms are 5 to 10 years. LTV will of course vary, a lot depends on the kind of relation. So construction assumption terms will vary significantly, but rate will typically range from 9.5 to 12% with negotiable DSCR requirements. This depends heavily on your relationship and the lender's comfort level. And then LRD financing offers 10 to 12 years with 65 to 75% LTV at 8.5 to 10% rates and 1.20 to 1.30 DSCR requirements. So these attractive terms reflect the security of lease rental streams. So these metrics can be used as negotiation baselines. Anything significant outside these ranges deserves scrutiny. Then we go to underwriting considerations. So lender evaluate 3 critical areas where when underwriting permanent financing, and understanding their perspective is crucial for success. So we have property performance focus that centers on occupancy trends and stability. Lender wants to see minimum 80 to 90% occupancy that's been maintained, not just achieved temporarily. Tenant credit quality and diversification matters enormously. One AAA rated tenant covering 60% of your NOI is different from 6 smaller tenants with mixed credits. Income quality and lease structure analysis examines lease terms, escalation, renewal options and rent rolls. Operating expense ratio versus benchmark helps lender assess management efficiency. Then coming to key financial ratios, 1.25 to 1.50x for DSCR depending on the property type. So office building might accept 1.25 times while retail might require 1.4 times. LTV maximum of 60 to 70% based on current valuation, not historical cost. Break-even occupancy analysis require substantial cushion. So if your break-even at 65% occupancy, lender are comfortable. If you need 85%, they are nervous. Then we have market analysis that encompasses sub-market vacancy and rental trends, new supply pipeline assessments and connectivity, infrastructure and connectivity factors that affect long-term value. Then we have lender due diligence process. So property level due diligence include detailed property inspection by engineer and construction professional, environmental assessment can cover both compliance and potentially liability issues. Engineering report and lease audits verify that what you have represented is actually accurate, and market analysis and valuation by independent appraisal establishes current market value. Then borrower level analysis focus on sponsors' financial strength, your balance sheet and liquidity. Background check and credit history will be very much required. Any surprise here will cause problem. Track record verification. So look at your previous developments and their performance. And existing debt obligation review ensures you can handle additional debt services. Then legal due diligence includes title examination and regulatory compliance. This is where incomplete documentation kills the deal. Corporate authority confirmation. It ensures you have the legal right to pledge the property. Litigation search and contract review identify potential future problems. So the key is transparency and preparation. And surprise during due diligence are deal killer. So honesty is the best policy. If anything is mischievously misquoted or not correctly represented, then that can lead to very big difficulties of maybe getting permanently blacklisted by that particular lending authority, or these kind of situations will actually erode the relationship completely. So that is why no negative surprises are expected in due diligence. Then let's take this case. So a grade A office in Gurgaon used traditional takeout financing, 500,000 square feet, 85% lease to MNC, achieved a 300 crore loan with a 12-year term of 9.25% rate. This straightforward approach worked because of high quality tenant and stable cash flow. Mixed use project in Pune employs a mini perm loan strategy. The retail office service departments combination created complexity that permanent lenders weren't comfortable with initially. A 160 crore 5-year mini perm for stabilization gave the property time to prove its concept before transitioning to permanent financing. And then retail mall in Jaipur used construction debt assumption, 350,000 square feet with 75% occupancy, wasn't quite ready for competitive permanent financing, but had a strong relationship with SBI. They modified the existing loan to 7-year term with improved pricing, avoiding the cost and complexity of the refinancing. Then the fourth example of tech campus in Hyderabad requiring a hybrid financing approach. The 3-building campus used component specific financing, LRD for the completed project, traditional takeout for the office component, and structured financing for amenity building. This combination approach optimized term for each component. So here we can see through this case that for 4 different cases, how we have seen that different approaches can work. So for grade A office, because of the marquee clients and the good quality office setup which they had, there was no problem for getting lending, and so they got traditional takeoff financing. Second case, we saw that in mixed use, where mini perm loan strategy was used because they were trying to have some innovative retail office serviced apartments coming together, and the lending firms were not comfortable with that, so they gave them option of this mini perm loan, and they took that for a period of stabilization, and once the stabilization will reach, they can of course then move. Then the third case was of a retail mall in Jaipur, where we saw that because of their strong relationship with the SBI, they went for construction debt assumption. And in the fourth case, we have seen that there is this tech campus which has different buildings, and one is completed and like that. So where they are using three different forms of financing, permanent financing. So this kind of different cases can happen in different situations, and somewhere you will see that there is a possibility of your regular permanent financing, and in some places you will see that you will have to go for LRD, or you might have to go for perm loan. So that kind of situation may prevail in reality. And then going to market trends. So emerging developments include increasing international investor participation. Global capital is finding its way to Indian real estate, bringing more sophisticated financing options. Growth of the REIT market is creating exit options that didn't exist 5 years. So this is something which is very new in India. We have seen few cases of this. And then focus on ESG consideration in underwriting is becoming standard. Environmental, social governance factors now affects your financing terms also. Rise of alternative property sectors, logistics, data center, that is also taking place, and lenders are aware of that, and they are accordingly giving them the the right rates. And the digital documentation platforms are reducing the processing time. So earlier hindrances and difficulties of manual processing is now getting reduced, and so the processing time is reducing, and that is helping overall business, because now while earlier we were talking about a longer period of time, which has substantially reduced because of the innovation of digital documentation and all that. So that has improved a lot. That is one big emerging development we can see. And then there are certain challenges also, like limited standardization in takeout arrangement. So every deal still feels custom, that is there. Then the documentation complexity and regulatory requirements continue to create friction. So even though the time might have reduced, but the complexity of documentation still remains there. And with the RERA, there are certain more requirements of regulations which have brought in, but though it has brought more transparency, but of course there has been more documentation also because of that. So that is there. And then conservative underwriting in tier 2-3 cities limit options outside the major metros. So we have been talking about all these new type of lending products which are there available in tier 1 cities, but they are not available in tier 2 or tier 3 cities, and much of that is still doing much of the business is still going on with the old systems and conservative approaches. So that has not changed much. And then interest rate volatility is affecting long-term commitments, and lenders are more cautious about fixed rate long-term loans. So that is still there. Then we have best practices for developers. So strategic planning starts with beginning your permanent financing process 6+ months before construction loan maturity. This isn't something you start thinking about when your construction loan is about to expire. Develop relationship with multiple lender types. Don't pull all your eggs. Put all your eggs in one basket, and then maintain strong property performance data and reporting. This becomes your track record, right? And then structure projects with permanent financing requirements in mind. From day one, design your projects to meet lender criteria. Then execution excellence requires preparing comprehensive documentation packages before you need them. Engage experienced legal and financial advisors. Consider multiple financing options and competitive terms. So you have to start thinking about this very early so that you can plan accordingly, and then plan for various market scenarios and exit strategy from the starting, so that you are clear about your approach towards the exit of this whole project, that how will you actually come out of it, and how, whether you want to be permanently invested or how you will be approaching the exit, that you have to think and be clear about from that perspective from the start. Then we move to future outlook. So continuous growth in permanent financing option, we can clearly see that there is a continued growth in permanent financing. Maybe it is restricted to tier 1 cities right now, but it is there. Then increasing sophistication of financing structures, more and more highly complex options are available now. And then greater integration with capital markets. We have seen that how REIT is becoming important exit route. And then enhanced focus on sustainable and technology enabled property. So whether it is your IoT or whether it is your green LEED certified buildings, they are taking importance, and ESG and all that is also influencing the lenders. And then we have regulatory developments, so potentially easing of ECB guidelines for real estate, which is happening, and then evolution of REIT regulation, expanding market access. So this is something is also coming up. And then streamlined approval process for permanent financing, that we will see with the newer technology which is being adopted, and enhanced transparency requirements from the regulators, because RERA has started that journey, and more actions will take place on that path. So with that we come to key takeaways. So strategic importance: permanent financing is critical for development, profitability and risk management. Option diversity: multiple financing types available, each suited to different scenarios. Through cases we have seen that in which case what applies. And then preparation matters: early planning and comprehensive preparation significantly improves the outcomes. And then relationship value: strong lender relationship remains crucial in Indian market. And the market evolution: increasing sophistication, creating more opportunities for developers. So conclusion: match financing to project characteristic and market condition. Build strong relationship with diverse lender base. Maintain excellent property performance and documentation. Plan permanent financing strategy from project inception. We have discussed all these points. I'm just trying to summarize them here, and then stay current with market trends and regulatory changes. We have to remember that effective permanent financing maximizes the development return while minimize the risk and creating optimal capital structure for long-term success. So with this, I would like to end this session. Thank you so much.